I am recording this late on Monday, February 9th, 2026, and I need you to pay close attention to every word I'm about to say. What took place today was historic. Silver surged sharply, jumping nearly 6% and finishing around the 80 to 83 range. For those who endured last week's brutal crash, today felt like vindication. It felt like a victory. Your account is back in the green. The fear has faded. And right now, the dominant emotion you are likely experiencing is the urge to sell. You are thinking, I survived the crash. I have recovered my losses and even gained more. I should take profits before this reverses. It is a normal, rational thought. It is the conservative thought, and it is the single biggest mistake you could make in this moment. I am issuing this emergency update with one clear and unmistakable message. Do not sell. Under no circumstances should you sell your silver on Tuesday, because as big as Monday was, Tuesday is set to be even bigger. What we witnessed today was the tremor. The earthquake is coming tomorrow. What we saw today was the ignition sequence. The rocket actually launches tomorrow. I have been analyzing the silver market for more than 2 decades. I have watched dozens of rallies and dozens of corrections. I have never, and I want you to grasp this fully, I have never seen a setup like the one we have heading into Tuesday's session. Every indicator, every structural market factor, every piece of fundamental data is aligned in one direction: explosive upside. I'm going to use this entire video to lay out, with data and logic, exactly why Tuesday is positioned to be one of the most explosive days in silver market history. You will see the forces that powered Monday's rally and why those forces will be magnified exponentially on Tuesday. By the time we are finished, you will understand why selling now would be like stepping off a rocket ship 1 second after liftoff. Subscribe to John AG Alert immediately and hit the notification bell. I will be providing live updates tomorrow as events unfold. Like this video and comment right now, because engagement determines how many people see this critical information. Share it with every silver investor you know who might be considering selling. You could be preventing them from making the greatest financial mistake of their lives. Let us begin by breaking down what occurred on Monday, because it sets the foundation for Tuesday. The rally that carried us from the high 70s to almost $83 was not random. It was not a dead cat bounce. It was not short-term noise. It was driven by 4 specific, identifiable forces that I'm going to walk you through in detail. First, there was the initial short covering. The banks and commercial traders who re-entered shorts during last week's rebound, expecting another crash, were proven wrong right at Sunday night's open. When prices gapped higher and continued climbing, their pain quickly intensified. They started covering their most vulnerable positions, creating persistent buying pressure throughout the session. Let me clarify why this short covering was only the start. When a trader closes a short, they are forced to buy. That buying pushes the price higher. As the price rises, more pressure builds on other short sellers, forcing them to cover as well. This produces a feedback loop, a virtuous cycle for longs and a death spiral for shorts. On Monday, we saw the first turn of that cycle. The weakest shorts capitulated, but the large players, the banks with billions on the line, are still in. They are bleeding, but they have not yet thrown in the towel. That capitulation is coming on Tuesday. Second, there was physical market pressure. The massive gap between paper and physical prices, with Shanghai around $130 and COMEX around $80, created an undeniable upward pull on the paper price. Arbitrage may be impaired for large players, but the price disconnect still signals that the Western paper price is mispriced. That reality keeps a relentless bid under the market. Picture it like a compressed spring. The physical market is reality. The paper market is the spring. You can press the spring down for a while, but eventually it must snap back to reality. The more you compress it, the more violent the rebound. We have pushed this spring to historic extremes. The snapback is now underway, and it will not end until the paper price converges with the physical price. That convergence point is not $83. It lies somewhere above $130. Third, we saw retail FOMO. Investors who watched a 31% crash followed by a 22% rebound from the sidelines finally found the courage to step in. They saw Monday's green candle, and the fear of missing out overtook their fear of another plunge. This wave of retail buying poured fuel on the fire. I monitor retail sentiment through social media, dealer sales reports, and search engine trends. On Monday, Buy Silver hit its highest search interest since the 2021 Wall Street Bet squeeze. Dealers reported a rush of orders that overloaded multiple websites. This retail wave is powerful, but it is still in the early stages. The retail traders who moved on Monday were the early adopters, the ones who follow markets closely. The broader retail crowd, the people who hear about silver from coworkers or see it on the evening news, has not joined yet. They will arrive on Tuesday and Wednesday. Fourth, we saw the very early stages of gamma hedging. As silver pushed above $80, market makers that were short call options at the 80 and 85 strikes began to buy modest amounts of futures to hedge. This was the initial spark. It was not the explosion, it was the fuse being lit. I want to make sure you understand this gamma dynamic because it is the most mechanical, predictable, and powerful force in Tuesday's setup. I will go into greater detail shortly, but for now, focus on this. Monday was the day market makers were stress testing their risk models. They watched the price approach their strikes and bought a bit of protection. On Tuesday, if the price continues to rise, that small hedge turns into panic buying. The algorithms do not negotiate, they do not hope, they simply execute. These four forces combined to give us a strong 6% up day. It was exciting, it was validating, and it lulled many into a false sense of security, making them think this is a good moment to take profits. They are mistaken. Every one of those four forces is set to intensify by an order of magnitude on Tuesday. This is the core of my thesis. Monday was the preview. Tuesday is the main feature. Let me walk you through reason by reason with enough detail for you to grasp the scale of what is coming. The short covering we saw Monday was the easy phase. It was the traders with weak stomachs and tight stops exiting. On Tuesday, we enter a different stage. I refer to it as the existential pain phase. Major commercial banks still hold huge concentrated short positions. According to the latest Commitment of Traders report, the four largest commercial shorts hold a net short position equal to more than 500 million ounces of silver. Their average entry price on many of these positions is likely in the 40s or 50s. They have been profitable for years, but as the price rises, their aggregate position moves toward break-even and then into loss. Work through the numbers with me. If a bank is short 100 million ounces at an average of $50 and the price climbs to 90, it is staring at a $4 billion paper loss. That is not just a bad trading day. That is a crisis. That means emergency boardroom meetings. That means calls to the Federal Reserve. That is the kind of loss that can threaten the solvency of an institution. Once silver moves through $85 and heads toward 90, these banks are no longer losing money only on their newest shorts. Their entire multi-year, multi-billion-dollar position begins hemorrhaging cash. This becomes an existential threat to their trading desks and potentially to their institutions as a whole. At that point, they face two options. They can add to their shorts, attempting to cap the price, yet they tried that last week and failed. The physical market is too strong. Adding new shorts now is like trying to stop a tsunami with a garden hose. Every additional short goes underwater almost immediately. They are throwing good money after bad. Or they can cover their shorts, not just the latest trades, but the core legacy positions they have held for years. Positions that in some cases underpin their entire precious metals operations. When they are finally forced to cover those legacy positions, the resulting buying is not a gentle stream, it is a tidal wave. They will not be buying a few thousand contracts. They will be buying tens of thousands of contracts, representing hundreds of millions of ounces. At current prices, there are not enough willing sellers to absorb that demand. The price will gap higher, triggering more stop-loss orders and forcing further covering in a self-reinforcing cascade. Monday's short covering was a trickle. Tuesday's will be a flood. Shorts will be buying not because they choose to, but because they must. They will be buying to survive. And that survival buying will be the fuel that propels silver into triple digits. I warned you last week about the massive wall of call options expiring this week. On Monday, we crept closer to the fuse. On Tuesday, we ignite it. I want to go over this again because it is crucial that every viewer understands it fully. Market makers have sold an unprecedented number of call options at the $85, $90, and $95 strikes. When a market maker sells a call, they accept risk. If the price exceeds the strike, they lose money. To manage that risk, they must hedge. They hedge by buying the underlying asset, in this case, silver futures. The speed at which they must adjust their hedge is described by a Greek called gamma. Gamma measures how quickly their required hedge changes as price moves. When the price is far from the strike and expiration is distant, gamma is low. They do not need to hedge aggressively, but as price nears the strike and expiration draws close, gamma ramps up dramatically. It becomes nonlinear. It becomes explosive. Here is the key point. Gamma behaves exponentially near the strike and near expiration. We are now close to those strike levels, 85 and 90, and close to expiration this Friday. This is a maximum gamma environment. Every dollar of upside forces exponentially more buying from market makers. On Monday, with silver around $82, gamma on the 85 calls existed, but was still manageable. Market makers were buying futures, but in a controlled way. If silver moves to 84 on Tuesday, that gamma roughly doubles. If it reaches 84.50, it doubles again. At 85, it hits peak intensity for that strike. Then, crucially, the gamma from the 90 strike, which has been dormant, starts to awaken. This produces a mechanical, nonlinear acceleration. It is not driven by emotion. It is not driven by fundamental analysis. It is driven by risk management algorithms that have no discretion but to execute. The market maker's systems will be compelled to unleash a surge of buy orders into the market, regardless of any opinion on silver's fair value. If silver breaks 85 on Tuesday, gamma from that strike will push it toward 90. As we near 90, the much larger gamma at that level will detonate. This gamma bomb is an explosion of forced buying that is mathematically certain to occur once we pass the trigger zones. This is the mechanism capable of moving us from 85 to 100 in a single trading day. It is not about fundamentals, it is not about narratives, it is pure market mechanics, and the setup for this to occur on Tuesday is as close to perfect as I have ever observed. On Monday we saw retail FOMO, individual investors who follow YouTube and Twitter piled in. That is a meaningful force, but it pales in comparison to what we will see on Tuesday, institutional FOMO. Pension funds, sovereign wealth funds, family offices, and large asset managers do not act overnight. They have committees, risk models, and investment policy statements. Their process is slow. They spent last week's turmoil on the sidelines, evaluating the chaos, running scenarios, and debating in their conference rooms. Monday's strong rally served as their confirmation signal. It showed that the crash was a shakeout rather than a structural trend change. It showed that buyers retained control. It showed that downside risk was limited, while upside potential remained very large. Institutions that have been considering adding silver exposure will receive the green light from their risk committees on Tuesday morning. Their buy orders will hit the tape. These are not small tickets. These are multi-million or tens of millions of dollars orders. An institutional choice to allocate just 0.1% of a large portfolio to silver can exceed an entire day's retail volume. A single sovereign wealth fund choosing to initiate a 1% silver allocation could generate buying pressure equivalent to weeks of retail demand. This institutional wave of capital has not yet appeared. It is scheduled to arrive on Tuesday. They will be chasing performance. They will be seeking exposure to what they see as the hottest asset on the planet. They will be preparing to explain to their boards why they missed the early move and scrambling to participate before the next leg higher. Their buying will arrive precisely when the short squeeze is accelerating and the gamma bomb is going off. Picture three separate tidal waves, short covering, gamma hedging, and institutional FOMO, colliding in the silver market at the same time on the same day. That is Tuesday's setup. That is why I am telling you not to sell. The underlying driver of all this is the physical market. The Shanghai price near $130 versus the COMEX price around 83 is the fundamental reality that cannot be ignored. The paper market can diverge for a time, but it must ultimately reconnect with reality. On Tuesday, that reconnection accelerates. On Monday, the paper price started moving toward the physical price, but the gap remains huge, close to $50. This spread creates an arbitrage that, even if it cannot be fully captured by institutions because of delivery issues, exerts a constant upward pull. Everyone in the market can see the discrepancy. Every analyst is writing about it. Every trader is asking, why is Shanghai trading at a 60% premium? The conclusion, that COMEX cannot deliver physical metal, is moving into the mainstream. On Tuesday, the market will fully absorb the idea that taking delivery from COMEX is not a realistic path. That realization will trigger a rush into physical silver. Dealers will be inundated, premiums will spike even higher, reports of sold-out inventory and month-long delivery times will reach mainstream financial outlets. This rush into physical will spill over into the paper market. Investors unable to secure physical metal will turn to SLV or futures as the next best alternative. They will reason that if they cannot hold the metal itself, they can at least own exposure to its price. That shift will increase paper buying, accelerating the squeeze. The irony is that paper demand, driven by the scarcity of physical, will push the paper price up toward the physical price, closing the gap from below. Tuesday is the day the market collectively recognizes that the emperor has no clothes. COMEX does not have the silver. The paper price is an illusion. The only way to gain exposure is to bid the paper price up to where the physical market already trades. That level is not 83. It is well north of 100. The market is only beginning to understand this. Mainstream financial media always trails events. It is reactive, not predictive. It reports what happened yesterday, not what is about to happen. On Monday, outlets were still digesting the crash and the initial rebound. Headlines were cautious. Silver rebounds after volatile week. They hedged their language. On Tuesday morning, every major financial outlet, CNBC, Bloomberg, The Wall Street Journal, Fox Business, will lead with silver's explosive rally. They will display charts of the V-shaped recovery. They will feature guests talking about supply deficits. They will highlight the Shanghai premium. They will interview dealers who are out of stock. The narrative will flip from "is silver finished" to "how high can silver go?" That media coverage will draw in a new wave of completely uninformed retail capital that only just saw the headlines. These are not long-time silver stackers. They are not sophisticated investors who understand the short squeeze mechanics. They are ordinary people who see silver surges on their screens and decide to buy so they do not miss out. Their buying is emotional, undisciplined, and arrives at the peak of the excitement. This dumb money wave is the final powerful fuel for a parabolic move. It is the last cohort of buyers that pushes prices to levels that defy fundamentals but occur anyway because of pure momentum. This media-driven wave will hit Tuesday afternoon just as the short squeeze, gamma squeeze, and institutional FOMO all reach maximum intensity. The convergence of these flows is what creates a historic generational move. Now that you see why Tuesday is likely to surpass Monday, what should you do? Specifically, why must you not sell? Selling on Tuesday would be like selling GameStop at $40 in January 2021, right before it ran to $480. It would be like exiting Bitcoin at $10,000 in 2020. If you sell at 85 or 90, you will lock in a respectable gain. You will feel clever for a few hours. You will congratulate yourself. Then you will watch, horrified, as price runs to 100, 110, 115 without you. You will find it almost impossible to get back in. Spreads will widen to unprecedented levels. Liquidity on the offer side will vanish. Dealers will stop taking calls. You will be stuck on the sidelines, watching the rocket leave without you. The regret from selling too early in a parabolic move is one of the most severe forms of investing pain. I have spoken with hundreds of investors who sold silver at $30 in 2011 and then watched it rally to $50. Many never recovered from that decision. Some stopped investing altogether because the emotional damage was too great. Do not repeat that outcome. Do not become the cautionary example I reference in future videos. Here is the tactical plan for Tuesday, broken down by your situation. If you own physical silver, do nothing. Simply watch. This is your victory lap. You prevailed. You endured the manipulation and the volatility. You hold the real asset. Tomorrow is your reward. Do not sell a single ounce. True price discovery is only beginning. Your silver already commands about $130 in Shanghai. The Western paper price is merely catching up to that reality. If you hold unleveraged paper silver, ETFs, for instance, hold your position. Do not sell. The temptation will be intense, but you have to resist. Watch the $85 level closely. If we break through convincingly, the path to 100 opens. Consider pre-planning a target to take a modest slice, perhaps 10-15% off at much higher levels, such as 115 or 120, to lock in exceptional profits. But keep your core position. Do not walk away before the main course is served. If you are in cash and want to enter, this is a high-risk, high-reward choice. The ideal entry around 65 is gone. That train has already departed, but the larger move may still lie ahead. Buying at Tuesday's open means chasing strength, and you must recognize that. Yet it could also be the final realistic chance to board before the true explosion. A small starter position to gain some exposure can be rational, provided you accept that you are buying into strength rather than weakness. Size it so you can tolerate a 10-15% pullback without panicking. A final crucial warning on leverage. Do not use leverage on Tuesday. I cannot overstate this. Even during a powerful uptrend, there will be violent intraday dips. A sudden $5-10 flash crash can unfold in minutes as algorithms fire and liquidity evaporates. If you are leveraged, you can be liquidated on a brief downtick, even if the market finishes the day $20 higher. The volatility is too extreme for leverage, period. Stick with unleveraged positions. Your aim should be to capture the move, not to amplify it with borrowed money that can wipe you out. Let us pull everything together. Monday's rally was driven by initial short covering and retail FOMO. It was the warm-up. It was the opening act before the headliner. Tuesday's rally will be powered by existential short covering from major banks facing multi-billion-dollar losses, exponential gamma hedging from market makers as we cross 85 and 90, a flood of institutional capital entering after Monday's confirmation, a scramble into paper as physical supply becomes unobtainable, and a media-fueled wave of uninformed retail buyers chasing headlines. These five forces are all poised to converge tomorrow. This is why Tuesday is set to outshine Monday. This is why you must not sell. I have laid out the argument. I have shown you the mechanics. I have highlighted the trap of selling too soon. The choice, as always, is yours, but I have rarely felt this level of conviction about the setup for a single trading day. The banks have lost control. The physical market has delivered its verdict. The paper market must now adjust to reality. That adjustment takes place tomorrow. It will be violent. It will be historic. And it will reward those positioned on the right side. This is John A.G. Alert. Do not sell. Hold firm. Tuesday is the day we have all been anticipating. The manipulation is breaking. The shorts are failing. The physical market is asserting dominance. The gap between East and West is closing, and it is closing to the upside. Everything I have been outlining for years is now unfolding in real time. Do not flinch. Do not waver. Do not allow fear of a pullback to rob you of a generational opportunity. Subscribe now and turn on notifications. I will be with you tomorrow, tracking every moment of this historic session. I will post updates in real time as price moves. I will call out key levels. I will be there when 85 breaks. I will be there when 90 falls. I will be there when 100 becomes reality. This is your moment. This is our moment. The silver market is being repriced before our eyes.